Hey everybody, this is Coach D here with TackleTrading.com, and I just had an awesome exchange on the comments on our YouTube channel from a video I did way back in June. Back on June 15th, I made a little video talking about out-of-the-money call options and, the idea of buying out of the money call options being a bit of a sucker's bet because the probabilities are stacked against you. And then I get this comment today, just about 13 hours ago or so, that kind of flies in the face of what the content of that video. And I just really wanted to share this with you and just give a shout out to this person because they crushed it, they got lucky, and I want to talk about it and just kind of bring them into the conversation, bring them into the fold, and just kind of, have an open and honest conversation about the idea of what happens when you get lucky. So here's the question. So here's the video. Again, should I buy out of money call options? And generally, there's a time and place for out of the money call options. There really is. But generally, as a core trading rule, you don't buy out of the money call options, particularly short-term ones. Yeah, they're cheap, but the probabilities are low. Now, of course, there are exceptions to the rule, and there are ways to speculate using out of the money options safely and smartly. And so I get this question today, this comment from Kim, from S. Kim. And I don't know S. Kim. They just found us on YouTube, and we had a little exchange here. And so, this is kind of how the exchange goes. I'm new to options trading, and I think I bought a monster. Questions. So at the time the stock was trading at $5 per share, I bought $15 call options, 5-month expiration date, so out in January. And now the stock's up at $12, which is near the money. Okay, so that piqued my curiosity. Of course, I want to answer the questions on YouTube. So now we had a little bit of an exchange. So again, by the way, I bought the $15 call option for an average price of 90 cents. The stock is trading at 12, and they're going for a little over $3 now. So first of all, congrats on the win, S. Kim. I sincerely mean that. This is an awesome outcome for you. I'm extremely happy for you. But I want to come back and I'm going to talk to you about this. You got lucky. You got darn lucky. And you need to thank the market gods, and we need to have a conversation about what to do next. And again, I don't give advice, but I want to make sure you understand the implications of the trade you're in. So, congratulations. Before I knew any of your information, I said, one idea is you might consider selling, 1 or 2 contracts to cover your cost base of the initial investment. Now, I had no idea how many contracts you had. I deal with a lot of people, and a lot of times new traders will deal with 1 and 2 contracts, maybe 5, 10 contracts. And so after our exchange, again, you bought 100 call options. So you have 100 contracts at 90 cents cost average. That means you had $9,000 at risk, and you could have very easily have just lost the $9,000 had the stock not gone up, had it gone down and time decayed, and you just held on to it, et cetera, et cetera. And hopefully you understood that and knew that. So you bought the $15 strike price for 90 cents. Again, how many contracts? And I figured out, you have 100 contracts. I'm like, wow, well played. So I did the math, and you're up almost 30K on the trade. Awesome outcome. Again, phenomenal. I just asked if you were a Tackle member, if you'd been plugged into our community. And of course, you say, you're not a member. You just came across it learning about options. So here's the reason I'm making the video. One, I'm just glad you found us, because when you're trading options particularly, without a really solid knowledge and foundation of understanding of the potentials for risk, you can get lucky sometimes, but more often than not, what happens is you're wielding a lot of leverage, and it's just as easy to lose a lot of money with options. And so, the thing I said here is like, hey, the Kodak has a very uncertain future out there. We think the trade you won on, it's a very rare outcome. Probabilities aren't necessarily in your favor when you're doing that. And the fact that the stock price popped up, went the direction you thought, you speculated well, congratulations. But Kodak has a very unclear and uncertain future ahead of it. It could be bullish, could be bearish, but there's rumors of SEC investigations, some sketchy backdoor dealings there. And, who knows what the future holds for that particular company right now. And I don't know. And, you've got contracts that are good through January, but you still have $9,000 at risk. Even though you're up 30K, you still have 9K at risk. So we don't give direct advice at Tackle Trading. That's not what we do. But if you were my sibling, my brother, my sister, my cousin, what have you, and you came to me and say, wow, look what I did, Noah. I bought these 100 call options for 90 cents and the stock price popped and now I don't know what to do. The first thing I'd do is say, congratulations, you're buying dinner, because congratulations, you're buying dinner. And then I'd say, you know what, you really need to make sure you're locking in the gains. Get rid of the risk, at a minimum. And I wouldn't tell you what to do, but we would have a conversation about the potentials for the outcome. So I'm going to switch gears here. And actually what I did is I went in and just duplicated. I went to a virtual account, threw in 100 contracts of the January 15 strike prices. I put in the average cost base of 90 cents. And this is what your risk graph looks like. So you have this position where you're up about 26K at the moment, based off of the current pricing, current date, current time expiration, et cetera, et cetera. So you've got a killer profit on that, but you still have the initial $9,000 risk, and your break-even point is actually out here at $15.90, the $15 strike price, plus your 90-cent expenditure on the option premium. So $15.90 is your break-even point. And as of today, these options expire in January. As of today, if I were to set the price slice to the chart, to break even, on the expiration date, you have an 80% chance that the stock still expires below your break-even point. So there's an 80% chance that you still don't make any money if you let this go through expiration. There's a 19.37% probability, if you see that number up there, that you could make potentially more money. And, there's unlimited upside potential here. You could make 90, 100 grand if the stock price kept rising. But the reality of it is it's just an unknown. And because you still have the $9,000 risk, the first thing I'd say is get rid of the risk. Do something, sell something to get rid of the risk. And so the first thing I do is say, well, look, hey, if you were to create an opposite order and I were to analyze that, and we were to throw that into the equation, and you could sell for the current price. Now, the current price, you could get $3.50 out of it. So you could get $3.50 per contract, and I would start out and see, well, what happens if you sell one? And that would reduce your risk to $8,650. Well, what if you sold two? What if you sold 10? So if you go 10 contracts, that reduces your risk to $5,600. Well, what if you sold 30 contracts? And if you offloaded 30 contracts, you'd be guaranteed at least a $1,200 gain. Now, $1,200 isn't that exciting compared to $26,000, but you would have no more risk in the trade, and you would still have the unlimited upside potential, but you couldn't lose. And again, that's, I'm not telling you to do that. I'm just saying I would consider getting rid of the risk. You could sell another strike price. Another possibility was, we'll say, hey, you spent 90 cents. You could go in and say, well, what if I went out to January and I found the first contract that was going for 90 cents and I went and sold the $40 strike and I pulled in 90 cents. If you could get, a buck out of that, and you sold 100 contracts, same number of contracts, you would have a risk-free trade, guaranteed you couldn't lose. You'd have upside potential up to $250K, and you'd have no risk because you'd have the right to the stock at 15, a promise to sell it at 40. No risk in the trade because if you spent 90 cents and you brought in $1, you'd come out 10 cents ahead, times the same number of contracts. So you'd be guaranteed to make at least $1,000. It would cap your gains. Anything above $40, you'd get called out. But the statistical probability of it going above 40 at this moment, based off of the current math models, is like 5% chance. So that means there's a 95% chance it doesn't go out there. But you could have reduced risk, and again, in a capped gain. Versus the other idea, which is, sell 30 shares, guarantee you make $1,200. If it ran out to 40, you could make an unlimited amount of money. But again, statistically speaking, you'd only make about $180,000 if it went out to 40. You'd have to go out to 50 for you to make the $250,000. The adjustment where you sell the higher strike price and you reduce the risk means anything above 40 would make you $250,000. So it would have to get to 40 or above. Now, again, these are just potential probable outcomes. Guaranteed, not a guarantee. I have no idea what's going to happen on Kodak, and neither do you. And that's why you really do need to thank the market gods, take the money and run, make sure you have no risk, maybe take it all off the table, take 100% off the table, do whatever you want, take a vacation, reinvest the money. But don't let that stay out there with risk still. And again, just understand that, hey, in this case, I would love to just give you all the credit in the world for being the smartest person in the room and picking Kodak and knowing that the stock price was going to go up. But I got a feeling that you got lucky. And it's not that you're not smart. It's just that kind of trading strategy over time just doesn't bear fruit. It doesn't consistently win. Statistically speaking, over time, that same strategy is probably going to bleed you dry. So I would love to have you come join our community. I'm going to give you a free trial. As Kim, don't know who you are, but just want to get to know you more. Give you a free trial of our services over at tackletrading.com, so you can come join our community, come watch some of our training videos, learn some of the concepts and strategies and the discipline, join our trading lounges, etc., etc. Plus, I know you got some money burning a hole in your pocket. Maybe you'll join and subscribe and benefit from being a member of Tackle Trading, because it's not very expensive. It's like $97 a month. But you get the scouting reports and the watch lists, and again, the access to the playbook and our daily trading lounges where we just talk shop strategy. So you can become a more disciplined, consistent, and really it comes back down to just having a good structure for your trading so that you can hang out with other traders, learn more and more about the option strategies. And, again, just congratulations. I'm so incredibly happy for you. Do not let a winner turn into a loser. Take that money and run. Lock in the gains. Do something. And make sure you reinvest some of that money into your education. And don't just go out and blow it speculating on other stocks. Get yourself a good, solid foundation. Whether you do it with us, you do it with somebody else, really don't care. I'd love to have you in our group because, again, birds of a feather, we flock together, and we have a lot of fun doing this. And just awesome concept, awesome trade, awesome outcome. Hopefully this video was helpful for you as well as other people out there. And again, this is Coach D signing off.